Compounders, Brad here. So this is part two of Li Lu's Q&A that I started a few days ago. We're going through 12 questions that Li Lu was asked in 2019 at Peking University after he gave a talk there. And this Q&A was originally in Chinese, so it had to be translated into English for me to be able to read it. So it's one of those rare Li Lu Q&As. He really doesn't do many of these. And actually one of the questions gets into why he doesn't do many speeches, many talks, many Q&As. It's pretty interesting. But let's take off where we left off last time. Question 6. Can you please tell us what are the most important sources of a company's moat? Is it a brand, the management team, or its business model? What types of moat do you value most? So Li Lu responds to that by saying, this all depends on your investment horizon. The longer your investment horizon, the more important industry dynamics become for protecting your moat. The shorter your investment horizon, the more important people become. The source of each industry and each company's competitive advantage will be different, as will the degree to which they can protect their moat. We hold ourselves to the same standards and use the same analytical methods when looking at each industry. However, after spending much time on our research, we ultimately reach the conclusion that most companies are too hard and predictions about them cannot be made. The changes in many companies themselves do not make for sustainable competitiveness. Take the simplest example, restaurants. At any time, there will always be a group of restaurants in Beijing with the best business, and some cuisine will always be the most popular. However, you will see that after not too long, these will change, because even though they're doing well now, it's hard to guarantee that they will still be doing well in the future. You can spend a lot of time on industries like this and ultimately realize the same thing. They are too hard to predict. So speaking for myself, I put all my efforts into looking at industries about which predictions can be made. Within these industries, I then look for exceptional companies. And not just exceptional because of their industry, but on their own merits. I define exceptional as having returns on capital well in excess of their competitors. Really important point there. Within these companies, I then look for things which really interest me, which I think I have the ability to research or which are already within my circle of competence. So, I think those are tied together. Really interests me. Think I have the ability to research. If you're more interested in something, it just becomes easier to let that curiosity kind of help you understand, to spend the time analyzing it. The companies which make it through the selection process are the ones I will then go and spend time on. There are about 100,000 listed companies around the world, but you shouldn't ever try to study more than 5 to 10 at a time. Your most important work is therefore to find a way to cut this number down. There are many things you can ignore, and many which are outside your circle of competence. The most important thing you can do then is to ensure that when an opportunity comes up, which is within your circle of competence and fits, you don't miss it. But if an opportunity doesn't fit, you can completely ignore it. Go back to what I said at the start. You must understand yourself relatively well, and then you can be picky in your choices. Once you understand a company, you can just sit and wait until an opportunity comes when the price gives you sufficient margin of safety. At that point, you won't lose money, even if you're wrong. This is when you can go all in. This is why you should focus your research on things that you can understand well and understand clearly. And since you will only be choosing a few companies, you might as well choose the very best ones. Of course, you can also choose the smallest companies or those whose price is already cheap. If you understand them well and there is sufficient margin of safety, you will not lose money. In short, you want to invest in certainty and avoid uncertainty. When price can give you certainty, then price becomes the most important consideration. When your own knowledge, ability, and judgment can give you certainty, especially when you have been researching truly exceptional companies, then you don't need to constantly change your watch list every few years. You can just keep going and let the companies you own do the compounding for you. So, great stuff there, guys. Let's jump on to the next one. Question 7. Thanks to your speech, we now know a bit more about the special traits a value investor needs, particularly in terms of temperament. Amongst the entrepreneurs on whom you focus, what kind of special traits do they possess? So I'm guessing they're asking about the business owners, right? The management team. I've been a generalist for some 26 or 27 years. I've seen both successful and unsuccessful entrepreneurs of all stripes. I've realized that market economies have a very special property. They can release a person's true potential. Many successful entrepreneurs actually have all sorts of issues in their ordinary lives. Before they were discovered by the market economy, you might not have wanted to associate with them. And if they had been in another industry, the odds are they would have failed. However, a market economy can allow any special or uncommon person, an outsider, to ultimately succeed within their niche. I've therefore never believed that someone who fits the conventional mold can become an exceptional entrepreneur in a market economy. It's a very interesting point there. The market economy enables people to set up businesses which reflect their unique traits and then go on to great success. For this reason, my conclusion is that there is no uniform standard for identifying what kind of person will go on to succeed. At the level of the individual company, though, it's not just about analyzing people. You can analyze why a person chose to build the company the way he did and why that enabled its success. For example, Jack Ma of Alibaba might not have managed detailed operational matters, but he knew very well how to manage people and use them. The kinds of people he used would then be very focused on the details, like Alibaba's CEO Daniel Zhang. Every person will therefore find the company which best fits him. And when you are evaluating that company, you must not jump to the conclusion that because someone is like such and such, then the business will succeed. I've seen many people who tick all the boxes, but whose businesses are very average. I'm sure you've all had the same experience. If you think about the people you know, I'm sure there will be some who are particularly talented and look like they have a lot of potential, but in the end, they don't do particularly well. This kind of thing happens everywhere. I therefore think that every company must be assessed on its own merits, with proper analysis done on its own unique circumstances. So this reminds me of how, like, Charlie Munger would respond when he's asked, how do you evaluate a company, right? There's no broad stroke you can paint on that. It's really in the details. Which is, Li Lu articulates that marvelously here. Question 8. As a student hoping to enter the investment industry after I graduate, is it best to work for an institutional investor as my first step? Do I need to apprentice myself to a teacher? So to that, Li Lu responds, when I was studying at Columbia, I also attended a value investing class like this one. At the time, Columbia was the only university to offer this type of course, and Warren Buffett would come once a year to speak. Someone would always ask him this question, and he would always say, the best way to learn is to go and work for the person you admire most. This way you will learn especially quick. After his answer, I decided to found my own company. Good one, Li Lu. The real reason I founded my own company was because I couldn't find any other work. No people are the same. Some people will learn faster under someone else's tutelage. However, there really aren't many people who practice value investing, and so there aren't many value investing firms either. Moreover, these firms don't usually need to hire too many people. Take Buffett's company, for example. It has more than 100 subsidiaries and employs more than 500,000 people, but his head office only has about 25 people. Until 7 or 8 years ago, there were only 2 investors managing some $500 billion in capital, Buffett and Munger. It's therefore hard to go and work for him. My company is the same and only has 10 or so staff. While it might be good to go and work for a value investor, the opportunity to do so is exceedingly rare, especially since the most exceptional investors seldom need to hire anyone. This is a paradox. This is the reason why we started this class and also hope to found a community of Chinese value investors. We want a whitelist of investors who have a long track record of independent results managing a single fund to a single style, not like those investors who launch 100 or more investment products. We need to find these kinds of people. Then everyone will be able to see that these kind of results are indeed real and possible. If I had never seen Buffett in the flesh, my understanding of stocks would have been stuck on the impression I gained from Cao Yu's play Sunrise. I would never have joined this profession. Naturally, I also wanted to work for Buffett, but he wasn't hiring. I remember Monish Pabrai actually reached out to Warren Buffett and wanted to work for him as well. And of course, there weren't any positions available. Now, we also don't hire people. I therefore think the best way to learn is self-study. That and having some contact with more experienced investors can go a long, long way. Here's the part I was talking about where he doesn't give talks very often. I generally don't speak in public, with the only exception to return to my alma mater, Columbia, to talk with the students of that same value investing class. Before this class was launched at Peking University, I had never given a lecture in China before. Even today, this is only my second time speaking in China. Why don't I speak more often? It has to do with investing and my own personal biases. Going back to the question on the difference between the sell and the buy side, it is our natural human instinct to sell. Everyone always wants to dress things up to seem better than reality. Otherwise, why would we spend so much on our clothes? Well, I don't, but a lot of people do. Similarly, we always want to present ourselves as having superior knowledge and judgment. Humans have a bias towards self-aggrandizement, which is very hard to change. And we intensify this each time we speak publicly, especially if it is about some specific stocks. It is important to maintain a healthy skepticism because no one can ever be 100% certain. If you get to 80% or 90%, that's already pretty good. But when you go out and speak in public as if you had 100% certainty, you fool yourself into thinking you have 200% or even 300% certainty. You lose even the slightest doubt in yourself. And the more you speak, the worse it becomes. This is why I generally don't like to speak in public. There's only one exception, and that's when I can speak with students. And that's only because this is such a rare opportunity. I don't talk about specific companies, but I can share my experiences. So that's fantastic. I mean, most YouTubers are really into, giving a lot of stock tips, right? That's how they drive the traffic. That's how they grow their channels. But it can be problematic when it comes to maintaining objectivity and rationality, especially if the story changes, right? With the company that you're invested in. If you've talked about that company a lot, you have these biases that have really been triggered, and you really don't want to look at any information that flies in the face of that initial investment thesis. So in summary, your first choice should be to go to work for someone you admire, right? Warren Buffett went to work for Benjamin Graham. The second choice is to study by yourself, and in the process, to also reach out to people you look up to. You must stay in touch with them. Classes like this are a good example. There are people here today who have flown in from all over the country, perhaps even some who have flown in from the US. It's actually very helpful, and I would certainly do it too if I were in your position. What we've discussed today should be especially useful in practice because, after all, value investing is a practical art. Furthermore, value investing is a solitary pursuit in which you must be responsible for the decisions. If you add more people to the discussion, it will become a committee and you will lose your objectivity. Group dynamics will take over and impair your judgment. Our innate biases are an astonishing impediment to investing. Our minds have not evolved in a way which suits investing, so you must train yourself. If you can work with a great investor, treasure the opportunity and seize it. But if you don't, you can still make your own opportunities. At the end of the day, though, self-study is the most important thing. You must experience these things for yourself. So a few things come up here. Mohnish Pabrai, one of his 10 commandments is thou shalt not have an investing team. And it's for some of the same reasons that Li Lu highlights here. If you add more people to discussion, it'll become a committee, right? Pabrai also says, if he hires someone, they're going to have a different circle of competence that he does. But he won't want to keep saying no to them. It's hard to, and he'll want to justify why he hired them, right? If he keeps saying no, we're not going to invest in that. No, we're not going to invest in that. Why did he hire that person, right? So there's that pressure to say yes and invest in things that Pabrai shouldn't be investing in because he doesn't have that expertise in those, so many areas. So a lot of great points here. All right, we're going to do one more. Question 9, I'd really like to go and buy stock in a cheap company to study it and learn more. But before I do, I'd just like to ask, what kind of margin of safety can research into a company's balance sheet provide? I can tell you are keen to buy stock or keen to research one and buy some more. Don't get the order wrong, though. Do your research first and then buy. I think your question relates to companies with a low price-to-book ratio, right? In today's market, there aren't many stocks like that, except in Asian markets, that is. I assume you can invest globally. And if you guys can't invest globally, I highly recommend Interactive Brokers. It's a great brokerage for, easily investing in most different markets around the world. There are about 100,000 stocks around the world which are traded daily. In Asia, there are still many companies you can look into. For example, the company may be profitable now and for many years into the future. You can verify the value of its assets, be they stocks, financial securities, or real estate. You can then subtract liabilities to derive a net asset value. If we say the net asset value, or NAV, is 100, there are companies which transact at around 50. Although this kind of opportunity is more rare now than when I started, they still do exist. It's strange, but the market always has nooks and crannies where you can find opportunities like this. If I was going to start again and didn't know anything at all, I might well start here again. I can grasp the concept, I can see what I'm doing, and even feel it. Even if I don't understand anything else about the company, I won't lose money this way. Guys, that is such an important point. If you buy $1 for 50 cents, it's very unlikely that you're going to lose money. However, in today's market and with the scale of money we manage, I can't look into this this company anymore. So I'm not really an expert, and I'm sorry to say that I cannot give you a satisfactory answer. I know this kind of opportunity exists in other markets, but I really don't know about China. Apologies. So, just kind of, if Li Lu was starting all over again today, he'd be looking for 50-cent dollar bills or 10-cent dollar bills, right? Looking in corners of the markets where there's these inefficiencies, right? Where the big guys, the institutional investors, aren't looking at these things, special situations. I subscribe to Value Line through a library in Virginia. The library membership is like $30. I get access to Value Line for a year. And there's a special situations report in Value Line that comes out every month. So, that could be a great place to look for these 50-cent dollar bills. There's also a number of different websites that kind of cover spin-offs. Another place to look where there's forced selling from the institutional investors who owned the parent company, and now this spin-off doesn't meet their rules of what they can own, so they have to sell, even if the stock is trading at a discount to intrinsic value. So those are some places to look for these market inefficiencies, these nooks and crannies where you can find opportunities. But that's it, guys. I just wanted to cover those 4 questions in this Li Lu Q&A video. I'm going to do one more in the coming days covering questions 10, 11, and 12. But I hope you enjoyed this. Let me know, which nugget in here you appreciated most. Obviously, there's just so much. Li Lu. I mean, Li Lu strikes me as kind of a modern day Benjamin Graham. Like back when Buffett went to Columbia and learned from Benjamin Graham. In the same way, it would be such a treasure to be able to study under Li Lu in the current investment environment. I just think he's perhaps the best investor out there today, at least from my perspective. But that's all I got for this one, guys. I will see you all in the next video. Take care.